Recessions can be scary. 1. Prioritize recession-proof investments. Not all investments suffer during a recession. Some industries actually stay strong or even grow when the economy slows down. Checkmark dividend-paying stocks. Companies with strong cash flow and consistent dividend payments provide income even when the market is volatile. Look for blue-chip stocks with a history of paying dividends through past recessions. Checkmark consumer staples and healthcare. People still buy food, household goods, and medicine in any economy. Grocery chains, pharmaceutical companies, and utility providers tend to remain stable. Checkmark gold and precious metals. When stocks crash, investors rush to gold as a safe haven asset. A small percentage in gold ETFs or physical gold can hedge against volatility. Checkmark high-quality bonds. Treasury bonds and high-rated corporate bonds provide stability and predictable returns when stocks decline. Light bulb key takeaway: shift part of your portfolio into assets that hold value in a downturn. 2. Keep cash reserves and buy assets at a discount. Recessions bring opportunity. When panic selling hits, assets become undervalued. If you have cash on hand, you can buy great investments at bargain prices. Checkmark avoid being fully invested. Keep 10-20% of your portfolio in cash to take advantage of market dips. Checkmark look for discounted stocks. High-quality companies often see their stock prices drop even if their fundamentals are strong. Checkmark stay patient. The market may keep falling before it rebounds, so don't invest everything at once, buy gradually. Light bulb key takeaway: recessions don't last forever. Buying assets when prices are low can set you up for massive gains when the economy recovers. 3. Avoid high-risk investments and debt. Some investments that seem profitable in a strong economy can destroy your wealth in a recession. Crossmark overleveraged stocks. Companies drowning in debt struggle to survive during downturns. Avoid stocks with weak balance sheets. Crossmark speculative assets, crypto, penny stocks, high-risk startups. These investments tend to collapse first in recessions. Crossmark real estate with high debt. If property values drop and you're overleveraged, you could end up losing more than you invested. Light bulb key takeaway: during a recession, defense is just as important as offense. Avoid high-risk moves that can wipe out your capital. 4. Invest for the recovery. Position yourself for growth. Every recession eventually ends. The investors who prepare during the downturn make the biggest gains when the economy bounces back. Checkmark tech and innovation stocks. Companies leading in AI, automation, and renewable energy are positioned for explosive growth when the market recovers. Checkmark real estate, post-crash opportunities. If home prices fall significantly, buying during the dip can lead to massive appreciation later. Checkmark index funds and ETFs. Low-cost index funds like S&P 500 ETFs let you invest in the entire market, ensuring you benefit when the recovery begins. Light bulb key takeaway: while protecting yourself in a recession is critical, positioning for the next boom is how you build real wealth. Final thoughts: how to come out stronger after a recession. Downward trend, stay defensive. Shift money into recession-proof assets. Money bag, hold cash. Use market crashes as buying opportunities. Prohibited, avoid risky investments. Don't chase high-risk stocks or take on unnecessary debt. Upward trend, prepare for the rebound. Invest in industries poised for long-term growth. Right finger, recessions don't destroy wealth, panic does. Stay calm, invest smart, and you'll come out ahead when the economy turns around.